Good evening, everyone. This is Rebecca Sharuk from the Office of Alumni Relations. I want to thank you all for joining us this evening, and I want to send a special thank you to Heather Jarvis for joining us. Heather is a student loan expert who's provided student loan education and consultation for universities, associations, and professional advisors since 2005. She graduated from Duke University School of Law, and she dedicates her life on behalf of the high-debt student loan borrowers. So we're very excited to have her here tonight. Heather, the show is yours.
Thanks so much, Rebecca, and thanks to the Office of Alumni Relations for making this possible. I am delighted to speak to everyone this evening, and I want to begin by encouraging you to ask whatever questions you have, whenever you have them, using the chat box here with our platform. So to begin with, everything is going to work out fine with your student loans as long as you're able to start with the understanding that it's a system that's overly complicated. So there's a number of kind of ins and outs to it that can be frustrating, but they're not unmanageable once you have a kind of framework for thinking about it. And so I encourage you to use some larger context by starting out with this sort of framework here of kind of a checklist approach. So everybody needs to begin by analyzing their present circumstances, and that relates to your student loans, but also your other financial circumstances, so that you can identify what your particular needs are. So that could include things like lowering your monthly payment if you're finding it to be unmanageable, or reducing your overall costs over time, things like that. And what I'm hoping to help you do is give you the information you need to determine what your options are, because you have a lot of options, sometimes more than might be ideal, and that's what can be confusing about it. So once you've gone through and figured out where you are now and where you're starting, you'll be able to determine your options, and then you can sort of select between those options and develop a strategy that will work well for you and your particular circumstances. And that's what will get you on the road to successfully carrying out that strategy. I do also want to recognize that we can only make plans that are based on the information we have and our sort of projections or guesses about the future. And a lot of these decisions are linked to things like future salaries and future income and earnings that are uncertain. And so whenever things do develop for you in your life, if you get a different job or get a promotion or move or get married or whatever, recognize that because of the flexibility of federal student loans in particular, you might want to change your strategy midstream, and you'd have a lot of times the opportunity to do that. So make a plan that makes sense for now, but then revisit it periodically, and when things change, or to the extent that they change. Okay. So with that kind of introduction, no matter who you are, everyone needs to get a clear inventory of their student loans, recognizing that there's a distinct difference between private and federal student loans. That's the sort of broad categories of student loans. And to inventory your federal loans, I recommend the National Student Loan Data System. It's available online at nslds.ed.gov. You'll use your federal student aid ID to log in there, and that'll show a list of everything you've ever borrowed from the federal government from the student loan programs. And if you compare that to your credit report, which you can get for free at annualcreditreport.com, you'll be able to, by process of elimination, hone in on the private student loans. So both kinds of loans will be on your credit report, and if you mark out all the federal loans from your credit report by comparing it to your federal record, then what's left will be your private student loans. It'll say student loan, and it won't be on your federal report. And do this process even if you're pretty sure you already know what you have. And the reason for that is that there are companies called loan servicers, and these companies are they're companies like Navient, Great Lakes, Nelnet, and they tend to be involved in the student loan system in a number of different places in the process. So, for example, Navient, previously known as Sallie Mae, is the loan servicer hired by the federal government to administer some of the federal direct loans that you're getting now. So they're federal loans. But they also have been a lender of private student loans in the past, and so it's the fact that you're dealing with, for example, Navient, doesn't tell us everything we need to know about what kind of loan you have. Okay. So annualcreditreport.com is where you get your free credit report. They'll try to sell you your credit score. You don't need your credit score, you just need your credit report. And that's where you get it, you're entitled to get it by law for free. And then the National Student Loan Data System is a much more complete source of information than the interface you might be used to using at your loan servicer's site. So, you know, you may be accustomed to going to like FedLoan and signing in and checking out your loan stuff. This federal database will be much less beautiful. It will be much more clunky and less user-friendly, but it also is far more comprehensive and will have a lot of info that you don't get as easily otherwise. Okay, so you're going to get a clear inventory of your student loans, and then I'm going to encourage you to really focus on what matters. So don't think about your student loans in a vacuum. You want to think about all of your money and finance holistically, and so that you can focus on the things that are the most important. Obviously, student debt is going to be a big part of that for many of us who have educations and have education loans. But it's also important to, at the same time, recognize that it's smart to put together an emergency fund, a rainy day fund, as they say. And having a little bit of cash in the bank is always a good idea. So before you start sending every dollar you ever earn to your student loans, you should first make sure that you have at least a little bit of a cushion. Now the amount that you need is debated. Some, times the traditional advice is like you need 6 months worth of living expenses. That can be unrealistic for some of us, but $2,000 is an amount that could prevent you from having to borrow more expensive money like credit cards, like to use a credit card, for example, when your car breaks down or whatever. So start with getting a little emergency savings in the bank. And then be sure you start saving for retirement early. So hopefully you will live a really, really long time and look something like this woman. This is what I am planning for myself. And you can't borrow money to pay for your expenses when you are retired. So don't leave money on the table. For example, if you work someplace that has some kind of a match, for example, for retirement contributions, be sure you put away at least as much as what your employer would match, and potentially some more as well. So that's important to start early, even when you owe money on student loans. Okay, so federal student loans are very flexible. There are about 1 million ways that you can postpone or reduce your payments on your federal student loans. They have potential for loan forgiveness, and we're going to talk about how to kind of evaluate these things. Private student loans are not as flexible. Examples of the federal student loans that you may have include these. So loads of people borrow from the Stafford Loan Program, which is sometimes just called direct loans or direct unsubsidized or subsidized loans. Undergraduates may qualify for subsidized loans if they have a financial need. And the subsidy just means that the government pays for the interest that accrues on those student loans while you're in school. And so you're not responsible for that, and also during certain periods of forbearance or temporary postponements of payments. But for unsubsidized loans, which most loans are, the interest starts to accrue right away and keeps on adding up until your loan is fully repaid. If you have borrowed for graduate or professional school, you're likely to also be using the Grad Plus loan program, and many of us have federal consolidation loans. These are all examples of federal loans. Perkins loans are a special kind of federal loan that are what we call campus-based. So they're federal loans, but you pay them directly to the university you were attending when you borrowed them. And they're kind of special. They have some special cancellation provisions that don't apply to most people, but if you have Perkins loans, make a mental note that you might want to think twice before you decide whether or not to consolidate Perkins loans. And we'll talk a little more about consolidation, but Perkins loans are really kind of special and could result in cancellation for certain kinds of borrowers. So for the few of you who may have those loans, just keep that in mind. There's also this Parent Plus loan program, and that's a loan that your parents may have borrowed on your behalf for undergraduate education, or possibly that you might have or the occasion to borrow for your dependent children at some point. Those loans are a little bit different than other federal loans, and many of the programs that we talk about tonight will not apply in the same way to Parent Plus loans. So if you have specific questions about those loans, please do ask them. And otherwise, I'm not going to address them very thoroughly tonight because they are unlikely to apply to, a whole lot of you. I just do want to note that don't assume that the plans we talk about are going to apply in the same way for parent loans. Okay. Now, to the extent that you have private student loans, or you might be considering private loans for further education, understand that in general they're more expensive and more risky than federal student loans. They have interest rates and provisions that are based on the lender's evaluation of the creditworthiness of the student, which means that people aren't getting oftentimes really good interest rates or terms on the private loans they get for school. Oftentimes they have variable interest rates, which just means that the rate changes over time on some sort of schedule, something like once a year or something. And sometimes there's no cap on how high the interest rate could go. So if you have private student loans, you want to determine whether you have a fixed or a variable interest rate. And you also want to evaluate whether there's any cap on any variable rate loans that you might have. Also recognize that private student loans tend to have co-signers in most cases, and you ought to get and read a copy of the promissory note for your private student loans. Most of us have trouble pulling it out of our file after any length of time has passed. If you don't know where the promissory notes are, and these are just the couple pages of fine print, the contract that you signed for the private loans, it's a good idea to request the promissory note from the lender, and you can determine who the lender is on your credit report. And then get up with the lender and request the promissory note, and then read it. You don't have to be a lawyer to read a contract. It's just words on a page. And the things that you want to look for are stuff about the interest rate, whether it's variable, how often it resets, whether there's a cap. And also look for a cosigner, and look for a cosigner release provision. So sometimes private student loans have cosigner release provisions where you can get the cosigner off the loan at some point. And that's a good idea if you can accomplish it. Having a cosigner protects the bank. It doesn't protect you as the primary borrower. It doesn't protect the cosigner, that's for sure. And sometimes the loans will have default triggers that can be linked to the cosigner. For example, some loans will have a provision like if your cosigner dies or declares bankruptcy, that can cause the loan to go into default and accelerate the balance, meaning that the full balance is immediately due. So if there's a cosigner release provision, you want to know it, and you want to know what the terms are. Usually it's something like you have to make some number of on-time payments and then apply. So that is worth pursuing if you have private student loans. Not planning to say a whole lot more about private loans except in response to any questions you might have, because there just isn't a whole lot to be said that is, you know, of a general nature. But absolutely do feel free to chime in with whatever questions you may have. So much of the rest of the information that I want to give you is about federal student loans. And I want to begin by introducing the concept that there are two very different paths to forgiveness of some or all, but some typically, amount of your federal student loan debt. Two different loan forgiveness programs. One is not tied to your employment at all. So it doesn't matter what kind of job you do or whether you're even working in the first place. If you choose an income-driven repayment plan, and we're going to talk about the income-driven repayment plans that are available for federal loans, if you choose one of those plans and you make the payments that are required over a long period of time, for most people it's 20 years, it can be 25 years depending on which plan you choose, and we'll look at that detail. But if you make those payments for that long period of time and you still have a balance on the loans, then whatever is left owing is canceled and forgiven, and you don't have to repay it. But the amount that is forgiven is considered taxable income to you. So that's less than fabulous. That takes some of the joy out of the moment of forgiveness, but it doesn't mean that federal income-driven forgiveness is not a good thing. It can be a very useful strategy and a very helpful circumstance, but it isn't. You wouldn't want to get a taxable forgiveness without having expected it, because you would want to prepare in advance by saving and putting some money away for tax. But if it's taxed as income, you know, that means that you could be paying, I mean, it's hard to say because it depends on a lot of things, but maybe 30% in tax, and owing, you know, 30% of your balance to the IRS is better than owing 100% of your balance to the Department of Education. And who knows, there may be no Department of Education or IRS by the time we get there. That was just a joke. There probably will be. Okay. Now, the second major category of federal loan forgiveness is public service loan forgiveness. So this is a separate and distinct forgiveness provision, and the way it works is that if you make 120 air quotes qualifying payments, then you could earn tax-free public service loan forgiveness. Now, 120 monthly payments cannot be made any more quickly than 10 years. So if every payment you make counts as a qualifying payment, then you could make 12 qualifying payments in 1 year, and it would take you 10 years to make 120 qualifying payments. But there are some circumstances where you could make payments that didn't count as quote-unquote qualifying. So it could take longer than 10 years to earn public service loan forgiveness, which is why I encourage you not to think of any kind of a clock metaphor or any kind of a counting towards public service loan forgiveness, because it really isn't about the passage of time. I've done lots of public service. I've worked in nonprofits for many years and never gotten a cent of loan forgiveness. So it isn't about working in public service for 10 years. That is only one part of what is required to get the forgiveness. So, and we'll go through the details of what else there is. Okay, for both these forgivenesses, both the long-term income-driven forgiveness, the one that is not tied to employment, the one that takes 20 or 25 years to get, as well as public service loan forgiveness, which takes 120 qualifying payments, both of those forgiveness provisions require you to select an income-driven repayment plan and make payments that are driven by your income. And so we're going to talk a lot about those payment plans. There are other payment plans available as well. And let me just, before I get into these details about income-driven repayment, let me just note one fact about federal student loans, all student loans actually, which is that you can always pay more than what's due. And for some people that will be exactly the right thing to do. So you can choose among the available repayment plans, and they'll assign a particular amount that you're supposed to pay under that plan. And you have to pay at least the amount that is required, but you can pay more if it makes sense for you to pay more. And we'll talk in a minute about how that can affect the way interest accrues over time. So the income-driven repayment plans are going to set your payment by looking at your adjusted gross income as reported on your federal tax return, along with the federal poverty benchmark that corresponds with your family size. So your family is yourself, the student loan borrower, your spouse, if you have one, your children that you support, if whether they live with you or not, as well as other people who live in your house and are financially dependent on you. So they determine your family size, you tell them what it is, and then they look at the corresponding federal poverty rate, and they take 150% of that amount. So 150% of the federal poverty rate for your family size is protected, and it's not required that you send any portion of that to your federal student loans. Beyond that, what your adjusted gross income is that exceeds that amount that we discussed is what's referred to as your discretionary income. And there's lots of great calculators. The materials will direct you to where you can play around with some numbers. But it's all driven by your adjusted gross income from your tax return. So it's usually the last number there on the first page of your tax return. And if you are a married person, your payments will be based on your combined income with your spouse if you file a joint federal tax return. Now, most of us married people do file joint federal tax returns, and that's because there tend to be tax advantages to doing that. You pay at a lower tax rate, you have credits and deductions that you can take advantage of that you might not be able to otherwise. But we always have a choice as married people about filing jointly or separately. And as student loan borrowers, there are times when it makes sense to file a separate return from your spouse, even if it means you might pay more in tax in a given year. Now, that's certainly not always the case, but it's something that you have to figure out for yourself. And the only way to know is to prepare your taxes both ways. So prepare a joint return, prepare separate returns for both you and your spouse, and then compare the total tax due under the joint filing scenario to the total tax due for each of you together under the separate filing scenario. And then also go through and see what the different filing status does to your student loan payments, both your monthly payments and also potentially your payments over time. whoops, wrong direction. And so I've got a little table here showing you of just some example payments. Now, remember that the first thing that happens is that they calculate something called discretionary income. Discretionary income is your AGI compared with the federal poverty rate for your family size. And then they set your monthly payment at a percentage of your discretionary income. For most of you, it'll be 10%. For some borrowers, if you have older loans, you might be considering a plan that sets payments at higher, at 15% of discretionary income. But this little table sort of shows you like what kind of payments you might be talking about. So if you're single, you're just a one-person family size, and you have an adjusted gross income of $60,000, your payment would be set at $352, and that would be whether you owed $50,000 on your student loans or $350,000. So what's unique about these repayment options is that the amount that you pay each month is not tied to the amount you owe. It's tied to your income. And that's really different than like traditional debt. And if you have a larger family, your payments are correspondingly lower, and if you make more money, your payments are higher. And these are not the only options you have. In order to choose an income-driven repayment option, most of the plans require you to demonstrate something called a partial financial hardship. And that doesn't mean you have to have income below a certain amount. It just means that you have to owe rather a lot as compared to what you earn. And this is somewhat oversimplified, but it's certainly you qualify to choose one of these plans if your federal student loan balance is not much lower than your annual income. So if you earn twice as much money as what you owe on your federal loans, these are not the right plans for you, and you may not qualify for them. But if you owe twice as much as what you earn, then you would definitely qualify, and it would be something you might want to consider. Whereas it's essentially a one-to-one ratio where you'll know you're qualified to choose it if you owe about as much or not much less than what you earn in a year. Now, unfortunately, there are a slew of income-driven repayment plans, and they all have nasty acronyms and all kind of different weird eligibility requirements. So I'm going to take you through some of this detail, but I also want to just direct you to the materials that are available there for you to download, because there's a really good table that's put together by the Department of Education that is going to really summarize the complicated eligibility requirements and the detailed differences between how the payments are calculated, whose income counts and under what circumstances, when the forgiveness kicks in, and also some really nuanced rules about interest accrual that are important potentially for you to take a look at, but that are not, something that we need to get, all at once. So the main eligibility requirement for these different plans is when you borrowed your first federal student loan. So I borrowed my first federal student loan a million years ago, like when dinosaurs roamed the earth. But you'll need to double check or recall when you got your first federal student loan. And if you started borrowing fairly recently and you didn't have any balance before July 1st of 2014, that is what is required to qualify for the so-called new income-based repayment plan, or income-based repayment for new borrowers. If you didn't borrow any loans before October 1st of 2007, and you are still borrowing or did borrow something after October 1st, 2011, then you're able to qualify from a loan perspective for the pay-as-you-earn plan, known as PAYE, pay-as-you-earn. Pay-as-you-earn is preferable to the new income-based repayment plan. They both set your monthly payments at the same percentage of income, 10% of discretionary income, and they both offer that long-term forgiveness, the one that's not tied to employment. They both offer that after only 20 years. They're both eligible for the public service loan forgiveness plan or program, but they, excuse me, I think I'm about to sneeze, and I don't want to sneeze right in the microphone and make a big blast your eardrums out. But so the difference between the income-based repayment plan for new borrowers and pay-as-you-earn is that pay-as-you-earn has a interest provision that is preferable. So when interest accrues on your loans, there are certain events that can cause it to capitalize or be added to the principal balance of your loan. And if that occurs, it's expensive because then the interest is added to the principal and it becomes principal. And when it's principal, it generates its own interest, so it costs you money and you're being charged interest on interest, which is not cool. So to the extent that you can avoid capitalization or limit it, that's a plus. And the pay-as-you-earn plan caps interest capitalization at 10% of the original principal balance. Okay. Wait, sorry. The old income-based repayment plan, the original plan, gives you somewhat more expensive payments, 15% of discretionary income, loan forgiveness after 25 years. And people often ask me, well, so then why would I choose that plan? You wouldn't. You shouldn't. Don't. The only reason you would choose that plan over others is if you do not qualify to choose pay-as-you-earn. And you do not qualify to choose pay-as-you-earn if you have old loans from before October 1st, 2007. Okay, so in that case, you're not eligible for that. So you'd have to be considering the old income-based plan or the revised pay-as-you-earn plan, repay, which sets payments at 10%. So that's better than old income-based repayment. But if you have any borrowing from a graduate or professional program, any student loans from a program beyond undergraduate education, then the loan forgiveness provision period is 25 years. It's 20 years for people who have undergraduate loans alone. So that's the only reason why anybody would choose the old IBR plan. Okay, so I was going to talk some about interest and how the passage of time influences your bottom line and the cost of your loans. I also want to encourage you again to think about what questions you might have about your student loans, because this is a super good chance to ask them, because I don't know very many things, but I know a lot about student loans. So I know very little otherwise, but I have a depth of knowledge that is extremely narrow about student loans. So by all means, please do chime in at any time. So when it comes to borrowing money, you have to pay for it. So when you buy something with borrowed money, even if what you're buying is something really practical like an education, you have to pay for having spent money that you didn't earn before you earned it. You're spending someone else's money, the bank's money or the federal government's money, and they charge you for that privilege. And what they charge you is interest. Sometimes they also charge you fees. Usually they charge you both. But when you borrow money, you don't know how much it's going to cost you when you borrow it, because the amount it costs you depends on several things. It depends on how much you borrow. It depends on your interest rate. And it depends way more than most people realize. It depends a whole lot on the passage of time, on how long it takes you before you pay them back everything you borrowed. And so you might think about like, oh, I borrowed, $10,000 at, 5%. And you might be thinking to yourself, okay, well, 5% of 10,000 isn't that much. And, that's all that's what I'm paying. No, it's that you're paying, 5% round the clock until it's repaid. And let me show you an example of that just so that you can kind of feel it in a way that you normally might not. I'm still fighting this sneeze. It's like coming up in the nose, but it's not quite going. Holy cow. Okay, so you're likely to have a variety of different interest rates on your federal loans. If you have really old loans, you might have variable rate federal loans. So that means that rate changes over time. But most of you are going to have loans at fixed interest rates that were set by Congress. So you got different rates depending on when you borrowed. Since July of 2013, you will have been borrowing at federal student loan interest rates that are fixed, so they don't change over time, but they're tied to the market. So what happens is that each year they set an interest rate for the following academic year. And again, whatever private loans you have are going to have interest rates that are based on both the market conditions at the time you borrowed, as well as the lender's assessment of your risk as a debtor. So right now, for example, this is the scheme that's in effect at the federal level. They have a base rate that they get according to the auction of the 10-year Treasury note each spring, and then they add a certain margin or amount on it. And it also depends on whether you're in undergraduate school or whether you are a graduate student, or if you're getting a loan from the PLUS program, either as a parent or a grad student. So like right now, undergrads are getting loans at 3.76%, which is pretty great interest rate, through next summer, at which point it will change, but we don't know what it will be. That will depend on what happens with the Treasury rate in the spring, which will depend on what's going on with the economy, which will depend on a lot. Graduate students right now are getting loans at 5.31%, as well as 6.31% for the Grad Plus program and also for the parents. But note that if you're still in school or if you're contemplating additional education, I know that the Office of Alumni Relations is bringing this to us, so many of you are graduates, but I know you and I know you're education junkies, and you might end up back in school at some point because that's what people do. And so note that these loans have caps, but the caps are quite high. So at some point in the future, people could be borrowing Grad Plus loans, for example, at as high as 10.5% under the current scheme, if it is to continue. So here's the example to show you the difference in what happens with interest over time. So time really affects your bottom line. So this is just an example, a hypothetical, where we have a person who borrowed $100,000 at 6% interest. So $100,000 at 6% interest. And let me get my little tool here so I can show you. Let's say that she borrows $100,000 at 6%, and let's say she pays it back over 5 years, just 5 years. That would require monthly payments of $1,933, and over the 5 years, the interest that she would have paid would be just under $16,000. So her total out-of-pocket cost would be, oops, that was not the plan, Heather. All right, hold on. I got my little wheel here on my mouse that I'm going a little crazy with. So her total cost would be $115,996, just under $116,000. Whereas if it took her longer, 10 years, her payment is less, so that's good. But the interest she pays is a lot more, and her overall costs are a lot more. And if she really takes her time repaying the debt, yeah, it gets her monthly payment down. But the interest that accrues is way higher, and she ends up paying back about $172,000, of which close to $72,000 is interest. So there is a distinct advantage to repaying debt quickly when you're able to, and if you're not going to benefit more from pursuing one of the federal loan forgiveness programs that we discussed. So recognize that because of the way interest accrues over time, it's really expensive to postpone making payments. The feds have all these different ways that we can get out of making payments. But if you find that it's not the right time in your life to make high payments, think about choosing one of those income-driven plans that provides a monthly payment that recognizes your income and factors it in when determining how much you should pay. And there are several advantages to doing that, not just because you are getting started towards something on your debt, but also because you would start towards the possibility of at least that long-term forgiveness that's not tied to employment. Whereas if you just postpone payments by getting a forbearance, your interest accrues, your debt adds up, and you're not getting any closer to getting any cancellation because you haven't entered repayment, as they say. Okay, all right, well, let's look at another example. Here's another example of just $100,000 student loans. I think I assumed a 6.8% interest rate in this example because your interest rates are going to be all over the place depending on when you borrowed. In this case, if she was to repay the loans over 10 years, it'd be about $1,174 a month for 10 years, whereas if she spread it over 30, it'd be about $682 a month for 30 years, and her out-of-pocket costs would be significantly higher. Whoa. So one of the ways to improve that scenario would be improving the interest rate, right? But there's no way to improve your interest rates within the federal student loan system. Oh, see, I'm getting a message now from Rebecca that there are a bunch of questions under the questions tab, but not in the chat box. And Rebecca, I will let you know I don't have a questions tab as a presenter. So I've got the chat box, but I don't have a questions tab. So I can't see them. And that's why I'm not answering them. Oh, I'm so glad to hear that you guys are actually asking questions, because I was sitting here going, gosh, nobody wants to talk to me at all.
It's Rebecca.
Yeah,
do you want me to read these questions to you?
Yeah, that'd be super, please.
Okay. All right, so this one is from Amanda Vargas. She said, I work for a nonprofit hospital and have for 14 years. I've had every loan payment on time and in full. I attempted to apply for the William Ford Forgiveness Program, and they told me I did not qualify due to the fact that I had consolidated by Stafford federal loans with another company, so it's no longer owned by the government. Is there any way around this?
Okay, good question. So, public service loan forgiveness by working in the hospital is earned by making qualifying payments. So in order to make a payment that is a qualifying payment, you have to make a payment on a loan that is eligible for forgiveness. And it sounds like what you've been told is that the loan you have is not eligible for forgiveness. Now, what is not clear to me in your circumstance yet is whether you actually refinanced it with a truly private loan, or alternatively, which I think is much more likely, that you have what's called a FFEL consolidation loan. FFEL stands for Federal Family Education Loan. And those are federal loans, but they are not direct loans. And only direct loans are eligible for public service loan forgiveness. So it's unfortunate, and I'm sorry to give you this information, but there is no going back and getting credit towards forgiveness for payments made on a loan that isn't an eligible direct loan. Now that said, it is possible that if you have one of these FFEL consolidation loans, which I think is the most likely thing, that you could reconsolidate it into the direct loan program, but unfortunately you would then have to choose an income-driven repayment plan and start making payments towards the 120 that are required to earn loan forgiveness. And the chances of you making 120 payments driven by your income over 10 years and still have something left to forgive, unfortunately, are probably significantly diminished because you've already paid so much money over 14 years.
All right, great. Thanks, Heather. So that's that one. So we have two more. So the next one from Shant Manoshigan, and I'm sorry, Shant, if I mispronounced that, but his question is, how are you actually calculating interest paid?
How am I calculating interest paid?
Yes.
Well, Yeah, so it depends on, like, so I use a few different examples, and I do have to I make assumptions for my examples about what interest rate I'm using because people have a variety of different interest rates, and so I use things that are, well informed based on what my best guess is about, like, around where you guys would be. But some of you might have loans at as high of interest rates as 8.5% for federal loans. You could have, a few of you might have loans even under 2% if you borrowed a whole long time ago for federal loans. Some of you will have private loans. Those I've seen, even higher, as high as like 18%. So I, make certain assumptions, and then the way that the interest accrues over time depends on how quickly or how slowly the loan is repaid. So I use various different calculators and can refer you to those, online as well, where they, spread the payments of principal and interest out over either a specific period of time, if we're talking about like a term repayment plan. So the so-called standard term for federal loans is 10 years, but can be as long as 30 years for consolidation loans. And so the other sort of part of it, and maybe this is what he's asking more specifically, is if you...
I'm sorry to interrupt. Shant did send a follow-up. He said from a few slides back, 6% on 100,000. Is that 6,000 over a year?
Oh, I'm going the wrong way again. I really tend to do that. So like this one. So this one, what I do is you spread, and actually this is, you take the principal, and then these are actually, no, these are simple, it's a simple daily interest calculation that applies to student loans. So the interest accrues on a daily basis, and it's calculated based on the number of days since the last payment. So I do it annually, and then I amortize it over the loan period. in question. And so, if you want to do similar things or different things, one calculator I really like is vinfoundation.org/loansim. And I'm typing this in, but I'm not sure, Rebecca, if this goes to the audience or if it just goes to you. I think I don't have the option of sending it to everyone. Other ones that are good are you can just Google amortization calculator and use, you'll get Excel sheets and such that are the types of things that I use.
All right, Heather, I'm going to send it out to the group because I guess it's not. So this is going out to the whole audience. Let's see here. There's the VIN. And then one more. And then we have one more question. And after I read this, I just want to tell everyone, if you do have questions, try to put them into the chat box. And that might make it a little bit easier. Sorry for that little mix-up there. Let's see here. All right, and I think that went to the entire audience. Yes, and so the last question I have from the questions tab is, hold on everyone, this is from Irina Belinsky. The majority of my loans are from after 2007, but some portions is from before 2007. Do I qualify for payee?
So unfortunately, if you had a balance that you owed, so if you had borrowed any amount from a federal loan and it was outstanding, so you had not fully repaid it as of October 1st, 2007, then unfortunately you don't qualify to choose the pay-as-you-earn plan for any of your loans. So the question is a good one. It seems like, you would think like, oh, I can't choose pay-as-you-earn for the older loans, but I should be able to choose it for the newer loans. No, it's a borrower-specific eligibility requirement. So those of us that owed money to the feds already on October 1st, 2007, just simply can't get, won't ever get access to the pay-as-you-earn plan. And the reason for that is, it seems like a very strange date range, but the reason for it is that the pay-as-you-earn plan was created by executive authority to adjust the regulations, and that was done by President Obama without additional funds being appropriated by Congress. And so the Department of Education had to, or felt they had to narrow the field of eligible borrowers. And so they were looking to get at people who were undergraduates in 2012 when the president was campaigning for re-election, because that is the group that he announced his intention of providing payment relief to. And so by cutting the rest of us out with older loans, they managed to afford this relief without congressional cooperation. So, okay, so thank you, Rebecca, and I will forge onward, and then do feel free, if I'll look for things in the chat box if people are able to get it to me, and if not, Rebecca will let me know about other questions so that I can take them. Was going to let you know a couple things about consolidation and as it relates to interest. So interest is, interest rates cannot be improved within the federal student loan system. There's something called a consolidation loan within the federal system. A federal direct consolidation loan is the only one that is presently available. There used to be two kinds. Now there are just federal direct consolidation loans. And there's also the potential for refinancing with a bank or a private lender, but that would mean leaving the federal system, as well as the benefits and unique consumer protections that go with it. So in the federal system, if you choose to consolidate your student loans, you're not going to get a better interest rate. You're just going to get a blended interest rate. So a consolidation loan is going to have a rate that is the weighted average of the underlying loans. So it's essentially the average, except that they weight each loan's rate according to its balance and what portion of the total balance that represents. So it preserves the cost really where it was, but you no longer have the ability to repay higher interest rate loans more aggressively. So consolidating shouldn't be done unless you know why you're doing it, and some people should do it. But mostly it's people who have those older FFEL loans, and we'll talk about that a little more in a moment. But I do want you to be very cautious if you're considering refinancing your student loans with a private bank. You can do it, and it does make sense for some people. But federal student loans have very unique consumer protections. Things like the ability to have the debt discharged if, God forbid, you became disabled, or if upon your death the federal loans could be discharged so that your estate would not be responsible for paying them. Private student loans, not so much. So it's the banks and lenders that issue those loans do not provide the same level of consumer protection that federal loans do. But they can lately compete when it comes to interest rates, depending on when you borrowed your federal loans. So if you already have good interest rates for federal loans, like you do if you've borrowed quite recently, you may not gain much, but some people who have higher interest rate federal loans and very good credit and strong incomes can get a bank to loan you money that you could then use to pay off your federal loans. But then you would have a new loan, a private loan, and it is likely that it would have far less flexibility, although it might be less expensive. So be cautious if you're thinking about that, because it's not for everyone by any means. The folks who can benefit the most from consolidating are those who have loans from that FFEL program. So if you borrowed before July of 2010, you may have some loans from the older program known as FFEL. And it just stands for, as I said, Federal Family Education Loans, and that's where banks and private lenders were originating the loans. They were funding the Stafford loans and the PLUS loans and the consolidation loans, and then the government was guaranteeing those loans. So the banks made the profit, but the government took the risk on those loans. And in the summer of 2010, we went to a system where all new federal student loans have been issued by the government directly through a program aptly named Federal Direct. And this is what we were saying just a moment ago, those federal direct loans are the only ones that are eligible for public service loan forgiveness. So those who have FFEL loans would need to take the step of getting a consolidation loan, a direct consolidation loan where you could pay off other federal loans. And that's really the main reason to consolidate at this point, although it also does serve to simplify things.
Heather, we have a few more questions if you wanted to take some now.
Yeah, this is a good time.
Okay, great. So this is coming from Christopher. He asks, how concerned should we be with the possibility of the payee and other forgiveness plans going away with the change in executive branch leadership, especially if it was an executive order? If this is the case, it would make little sense to make minimal payments while interest compounds. My concern is that I will start this forgiveness plan and will be stuck paying higher rates later in life if the forgiveness goes away at a time when my family will likely be larger with other expenses, i.e. mortgage, merely because I was not aggressive enough early out of school.
I hear that. Good question. So I got a couple of thoughts about that. Let me start with the personal stuff about your question and your circumstances, and complete that with some conversation about where I think policy might go or how it might affect you and people who have loans and are trying to make decisions now. So I think that it is always difficult, even if we knew that nothing would ever change, which is not the case, but even if we knew that nothing would ever change, it would be a difficult decision to make to say, well, I'm going to only pay a little on my loans, and I'm going to count on qualifying for forgiveness. And it would be difficult to choose to do that if you had an alternative of paying aggressively and saving in interest and not allowing the interest to accrue over time as much. I think it's very important to think about your own circumstances realistically. So I think that if you have a trust fund or a bank account full of money or a lot of disposable income that you don't have to use for other things now, that it's a very tricky question about whether you should use your resources to pay your loans so that you don't have the interest accrue over time. But I think for most borrowers, that's not the question you face. The question you face is, if I, should I stretch myself super thin in order to try to pay a little more quickly, or should I hope for the best and pay what is due and plan to protect myself insofar as I can from the worst? So I think it's important to sort of think it through in terms of your actual obligation. So, and that will depend a whole lot on how much you owe, how much you make, what your interest rate is, and what your projections for forgiveness are. If you owe 3 or 4 times as much money as you make, and then it is probably unrealistic to think that there is a strategy where you could repay your debt more quickly and benefit from reducing the interest over time, because just the principal balance in it itself would make that difficult. But if your debt to income ratio is much, much closer, and you do projections and you say, well, I might benefit a little from forgiveness, but then in that case, then maybe you really are much better off, just abandoning any kind of forgiveness strategy and paying more aggressively. But I think that the biggest risk that we have taken is in borrowing a lot of money to begin with. So it was a calculated risk, it was an investment in our future, it's very likely to pay off, but that's where the risk is primarily. It's not as directly in where you're choosing which repayment plan to pick, or even in how much to pay every month. So within the range of payments that you could in fact make with your resources, I think that's a difficult question. As far as the reality of the programs as they exist now and what might happen with them in the future, I'm going to tell you my thoughts about that. So, this is a question I've thought a lot about and answered many times before the election, and then I'll let you know to the extent that my thinking has changed since the election. So, to begin with, they change the rules about federal student loans all the time. They have never made changes that harm borrowers or make your options less palatable or less flexible. They have never done that retroactively in a way that hurts people with existing debt. So whenever changes are made, they are nearly always prospective, and they almost never apply to people with existing debt. And to the extent that they make things less good for people with debt, they have never been applied to people with existing debt. So they do them for new borrowers at some point in the future. Like, for example, I have a high school age son, and I am not at all convinced that he'll have access to anything like these provisions by the time he starts borrowing his student loans in a couple of years. But for those of us who already owe money, I think it continues to be extremely likely that we will be subject to the rules that are presently in place, because that's the way it's always been done in the past, and no one has proposed anything different. Although many proposals have been made to reduce the generosity of these programs, particularly as they apply to graduate and professional students. The proposals have all contemplated doing it prospectively. I think that, for them to pull the rug out from under people who were relying on the rules as they had been promised and as are codified in your promissory note and the statute that is referenced in that, as well as that you have relied upon, it would be unprecedented. It would be immoral, unethical, and it would be illegal in many ways. But which is not to say that I or anyone else could actually force the government to carry through with the promises it made. That's where my concern lies, is that yes, in fact, the government could do things that were illegal or unethical, and I'm not quite sure that we'd be able to stop it. Although we'd sure try, wouldn't we? So, but that said, as far as the incoming administration, it is significant that the Congress is now Republican in the House and the Senate. That does tend to result in lower federal investment in higher education and federal student aid, generally speaking. So I am not hopeful that rules will improve for student loan borrowers in the short term. I am in much more defensive posture, trying to keep things as good as they are and not let them get more expensive when it comes to access to education. I am certainly not holding my breath for any new debt relief programs, although it's not impossible. And when it comes to the executive authority and the regulations and such, I do think that there is more that can be done to mess with the regulatory provisions than with the other stuff. But income-based repayment and forgiveness, as well as public service loan forgiveness, are statutory and would require acts of Congress to change. There could be some messing around the edges of, for example, pay-as-you-earn, but I would be very surprised if that's anything that comes up anytime real soon. So yeah, I guess that's my answer. I don't know. I don't think that's the top worry. I think you should factor it into your thinking, but it doesn't necessarily mean you should send all your money to the federal government. You should pay the amount that appears to be right for you, and then maybe you should have the extra money that you've been, insofar as you have it, in readiness in case you need to change your strategy.
Great. And then we have another question from Ashley. If you carried federal loans and then consolidated them with the federal program, can you count the number of payments from the original federal loans, or does it reset your number of payments for the public service loan forgiveness?
So if you have made payments that count towards public service loan forgiveness, and on individual loans, they would have to be direct loans already, like a direct unsubsidized loan or a direct plus loan. If you had made payments on those direct loans that counted towards the 120, and you then consolidated the loans, you would lose that progress, because a consolidation loan would serve to fully repay those loans, and they wouldn't need any forgiveness because they would have a zero balance. You'd have a brand new loan that is a consolidation loan. And so you definitely shouldn't consolidate loans on which you have made payments that count towards public service loan forgiveness. But if you have one of those older FEL consolidation loans, you cannot have made payments that count towards public service loan forgiveness, or if you have any FEL loans. You could have, however, chosen income-based repayment for a FEL loan, because income-based repayment is the one income-driven plan that's available for FEL loans. So you could have made payments that had gotten some progress towards the 25-year IBR cancellation that's not tied to employment. And again, if you consolidated to get into the direct program and then you had a direct consolidation loan, you would lose that credit and you would have to start over. But it might be worth it if you're in public service, because you're not going to get there without a direct loan.
Great. And Heather, I just want to let you know that Chris said, exceptionally thorough and helpful answer. Thank you very much about that last question.
Oh, good. Exceptionally thorough. That's a euphemism if I've ever heard one. I was thinking right after I said it, I was like, dang, I went on and on about that, didn't I? Holy cow. It is something I think a lot about. I care a lot about, and I think a lot about. So, and I will too. Just while we're on a kumbaya moment, I will be fighting for us on these rules with all I've got. I will, it will be over my dead body that they take loan forgiveness away. So, maybe everybody can pitch in for my cremation. Okay, so got a couple more things I just wanted to address, and then I'm happy to take whatever other questions you have. Thank you, Rebecca, for reading them to me. I appreciate it. If consolidating is something that makes sense for you, or if you want to look into it more, studentloans.gov is the place to go. You sign in there, and that's where it all happens. But recognize that if you started borrowing before the summer of 2010, you absolutely need to check that National Student Loan Data System to make sure that you don't have those older FFEL loans, particularly if you're looking for public service loan forgiveness, because you'd have to consolidate before you could start making payments. I think I have that one in there twice. So the way that public service loan forgiveness works, and this looks like my formatting got a little bit messed up, you got to make the right kind of payments on the right kind of loans while you're working in the right kind of job, and you have to make 120 of those payments. So in order to get credit, you've got to make a payment while you're enrolled in one of the income-driven repayment plans, and you have to make that payment on a federal direct loan. At the same time that you're working full-time for pay for the government or for a 501c3 nonprofit. Many hospitals, as you know, are organized as nonprofits. But do note that some people who work in hospitals are not directly employed by the hospital, the nonprofit hospital. There are all kinds of different employment arrangements. So some people will be employed by a for-profit entity of some sort. So that's worth looking into if you're not sure. And public service loan forgiveness really is an all or nothing kind of a thing. So you have to make 120 payments in order to get full forgiveness. If you make 60 payments, you don't get 50% forgiveness. And the paperwork is going to be voluminous, so concentrate on counting the payments that count towards forgiveness as opposed to the time that you're working in forgiveness. And let's look at one more example to see how this could play out. This is our same example of someone who owes 100 grand. If she had an adjusted gross income of 54,000, and I'm assuming 3% annual salary increases and just a family size of 1, she could make payments of only $466 under the IBR, the more expensive plan, or $310 under pay as you earn, and she could pay very little over the course of 10 years based on her salary, and then have a substantial amount then forgiven, and again, not taxable under public service loan forgiveness. So this has the potential to be really great and super generous for some people. If instead she made these payments based on income and she wasn't in public service and she got the longer term cancellation, it would still serve to keep her payments affordable. She would still pay less out of her pocket than she would have under the 30-year plan. But she'd get a bunch of forgiveness, and then she'd have to be ready to pay tax on that forgiveness. And that tax amount could be significant. because it's going to be at whatever her tax rate is at that time. So that's, again, something to be prepared for. Also be prepared to cope with lots of annoying paperwork from your loan servicer. And I just want to urge you to be like as organized as you can bring yourself to be and as vigilant about reading their extensive correspondence as you can, because it's not a very friendly system. It's not very elegantly designed, and there are opportunities to make mistakes if you're not watching what's going on with your accounts. Specifically, if you enter an income-driven plan, be sure you're verifying your income each year when it's requested. You'll be asked to do so annually, as well as your family size, and it's important that you do that on time, or else they get all nasty and capitalize the unpaid interest. So they'll put the amount of interest that is outstanding onto the principal, which will cause more interest to accrue. So you don't want to miss their deadline. You'll need to, or it's a good idea to certify that you are working in a public service position. There's a employment certification form. It's included in your packet of materials. And recognize that there's going to be an application for forgiveness that you'll have to submit as well. That thing hasn't even been developed yet. And the reason for that is that the first people will become eligible for public service loan forgiveness this time next year. The statute took effect October 1st, 2007. So it's not possible to have made 120 payments that count towards public service loan forgiveness until 2017. And even then, it'll take a while before it kicks up. But there's another little sort of trap for the unwary, is that you've got to be in a public service job when you make each of those 120 payments, as well as when you sign off on your forgiveness application, and also when they grant the forgiveness. So it's important to remain and stay put in your public service job until all this happens. Okay. And then finally, a couple of other little sort of pointers, and then I'll take your last questions. This is an actual sign in Hawaii. This is posted in Hawaii. And there is a lot of wacky stuff going on in this sign. Like, to begin with, why is the dad the one carrying the lollipop and not the son? I don't know. Why is the mom's coconut so much bigger than the other coconuts? I don't know. I figure the lollipop is intended to indicate to us that these are tourists, because only tourists would get hit by coconuts, right? But in any event, this, I think, captures the kind of weirdness of the student loan system. Like, it is important that you stay focused on the details, especially if you're not a detail-oriented person. When it comes to public service loan forgiveness, the things that trip people up are forgetting to or not getting the information you need on time, like with our question we had earlier, and I'm sorry that I didn't catch the borrower's name. But if you don't consolidate older federal loans, including a consolidation loan, into the direct program, you can't make payments that count towards forgiveness, and many people have not been properly notified of that. You have to choose an income-driven plan. The plans that are sort of standard, so-called standard, are not going to count. It's important not to file a joint return with your beloved until you figure out what consequences that has for your student loans. You may still want to do it, but you shouldn't do it before you know whether you want to do it. Important to certify your income on time and file that employment certification form. And also, I said you have to make on-time payments for them to count towards forgiveness. And by on time, you would think that I mean not late. And while I do mean not late, I also mean not especially early. So you don't want to pay in advance, you don't want to pay ahead, you don't want to make lump sum payments, because you're not going to get credit for more than one payment per month. And if you make two payments back to back, one at the end of the month and one at the beginning of the month, or both in the same envelope, you're going to get credited them in the same month toward your account, and they're not going to get you toward the forgiveness finish line. This was going to be my little visual aid for like what to expect going forward since the election. Well, I don't know. I think that you should be aware that the Higher Education Act is up for reauthorization. So it expires periodically. That's what controls all this stuff. And it has been expired for some time. So Congress at some point will take it up again. It will be important for us all to be plugged in and expressing our views to the elected members of Congress. Because it is likely that these programs will become less generous over time. It's particularly likely that they will become less generous for future generations, and we also care about them in addition to ourselves. That said, I don't think that we need to worry a whole lot about our existing loans, although I can't be sure, and I'm not in charge, so I certainly can't guarantee that. But I think it's important to stay aware. And that is all I have for you. So by all means, please, Rebecca, if anyone else has any comments or questions, happy to take those now.
Great. So let's see. I have this one from Megan. What are your thoughts of the government changing the public service loan forgiveness program, specifically placing a cap on the amount forgiven? And if we're already currently accepted into the public service loan forgiveness, making qualifying payments, do you think we would be grandfathered in?
Yeah, so I really do think that if you are already on track, you've been making payments that count towards forgiveness, particularly if you're filing those employment certification forms, which you should do every year, I would be absolutely flabbergasted, stunned, and amazed if you got the rug pulled out from under you. I think that has not been proposed by even the most extreme members of the previous Congress. So I don't think that that's really a big concern. It absolutely would take an act of Congress to change public service loan forgiveness. It's part of statutory law. In terms of a cap, many people have that particular concern because the previous administration or the outgoing administration had proposed capping public service loan forgiveness in the president's annual budget request, which went nowhere for various reasons that you're probably familiar with. But so yeah, I think that you will hear proposals like that, and that will be the kind of thing that could well pass. But it's again extremely likely that I think that you being grandfathered in is not necessarily the right language to encapsulate what it would be, but yes, I fully expect that you would still have access to public service loan forgiveness as it exists today. But again, I can't guarantee it. It's not up to me. Congress has done things that were illegal before, and so but I don't think it's going to happen, and there isn't anything you can do to protect yourself except document your reliance on it and make your views known to your elected members of Congress.
Great, and so far we just have 2 more questions left. This is from Irina. Currently I have multiple loans, all federal, serviced by Great Lakes 3 loans, Navient 1 loan, and a Perkins loan. They range from 4.5 to 6.8% interest rates. Is it worth consolidating with the federal government? I have been making IBRs for the past 7 years, all low because I was a resident fellow and making very little. This year we'll start to make a salary, which is approximately what I owe in student loans. What should my repayment approach be going forward? I am single, have good credit, and hate having debt. the majority of which is at 6.8% because recent from medical school? Thank you.
So, I mean, those are the right questions. It's hard to give you personalized advice without looking at the details of the loans, although you provided much of the relevant information. I think what you want to do is, consolidating isn't necessary. There's no real reason to consolidate. You said federal loans, but I don't know that they're direct or FEL loans. If they're direct loans, you definitely don't need to or want to consolidate. That would just serve to make it harder for you to direct extra money to the loans at 6.8%. So essentially what it's going to come down to is you've got a couple of options. You want to project, are you likely to benefit from loan forgiveness? It sounds like probably not. Just based on what you've told me, your balance is probably not high enough as compared to your income for forgiveness to really be a great strategy for you. That said, if that's the case, and again, you'll have to look at the numbers. This is just general information, not necessarily responsive to your situation, but if you're not going to benefit a bunch from forgiveness, or if that's the projection, if I'm right about that estimate, then there's only two things you can do to minimize your cost. One is to improve your interest rates, and the other is to accelerate your repayment. So let's just say for a minute you didn't want to refinance with a private lender because you want to hold on to the federal benefits, or you don't qualify yet based on your earning or whatever. If that's the case, then the thing to do is to stay in the repayment plan that gives you the lowest possible required payments, and that may continue to be IBR. It might change actually though if you're making a lot more money. And then pay the minimum that's due on all the loans and send whatever else you can afford based on your other circumstances, like whether you have an emergency fund and you're saving for retirement, towards the loans that are at 6.8. Don't just willy-nilly send extra money, because they'll distribute it across your loans, even the lower interest rate loans. Alternatively, you could refinance with a private lender if you qualified for improved rates. You could probably do better than 6.8%. I'm not sure your debt to income ratio is where they would want it to be quite yet. If it's not now, it might be in a couple years, but then you'd need to be extra careful. Make sure you have enough disability insurance, life insurance, and savings just in case anything went wrong, because you wouldn't have the federal benefits anymore. Those are the kinds of strategies I would think about, and I would really encourage you to check out that calculator at vinfoundation.org. That was one I helped work on the back end of, so I know it's accurate, and it was designed for veterinarians, but it can be used by anyone, and it will really show you a lot of detail and how the different variables affect your bottom line over time.
Great, and I guess this will be the last question we have for the evening, from Shant, who said, half my loans are from before 2010, half after. Half are direct, half are not. I've been making payments since 2013, and the direct half is on its way to forgiveness, while the other half is not. I'm nervous to consolidate the earlier half because a lot of interest will capitalize, and I don't know where I will work after training, whether public service will be an option, etc. Is the earlier half, not direct loans, eligible for any sort of forgiveness at all?
Yes, so FEL loans are eligible for the long-term forgiveness if you choose income-based repayment, because that's the only income-driven plan available for FEL loans. You could earn the 25-year forgiveness if you still owed money on those loans at that time. And that's another reason to be cautious about deciding whether to consolidate those older loans into direct, because if you've already been in IBR during your training, you may already be working towards, it sounds like you must be, the way you said the question, you've made payments that count towards public service loan forgiveness on the direct loans, so you must be making IBR payments on the FEL loans. So those are on track for the 25-year forgiveness if you owe enough to have something left after 25 years. The way that you can figure it out, first of all, maybe you want to wait and see how things shake down after your training. You could think about running some numbers on that calculator and take your principal balance and take your outstanding accrued interest and try putting in the total as principal, and then spin out what would happen under public service loan forgiveness potentially, because that would show you kind of the potential if you consolidate it. And then do it the other way by keeping the interest separate from the principal and spinning it out for the longer term forgiveness, which sounds, which would take less than 25 years depending on how long you've been already making payments. And that's really the only way to go. But your question sort of points out what we all have, I think, what we all know sort of looking at this is that projecting forgiveness is so hard because it is extremely tied to your income and your earning over time. And the farther out you're trying to project, the less accurate your estimates are of what you're going to earn. You don't know what you're going to earn. And so you have to just, it really helps if you use the calculators and try a bunch of different things and recognize that there is no one true correct answer for what you should do. What you should do, like what would be ultimately best for you, is not knowable by us because we don't know what you're going to make or how, what the future will bring. So what you need to do is consider the information that is available to you now and make a reasonable decision based on your best guess about the future, and try not to foreclose options that seem like they might be likely or useful to you. And then beyond that, you just have to develop some level of acceptance for the fact that there isn't a perfect answer. So you do something that makes sense now according to what you know, and then you reevaluate once you have more information or if anything changes.
Great. And Heather, if you think we have one more question, if we can get it in. And Irina said, thank you. This webinar was extremely helpful. You rock. So yay for that.
Thank you.
And then this last question that we'll take is from Peter. Peter asks, I would like to meet with an advisor for individualized advice about my situation. I have been making qualifying payments toward PSLF for several years. Are there particular credentials or types of advisors I should look for?
Yeah, that's a good question. And one of the things I'll do is I'll send to Rebecca and ask her to get out to you, because I know she's got registration information about everyone who's joined tonight. Some of my thoughts about selecting a good advisor, because it's pretty complicated. There are very few financial planners and advisors that have detailed, nuanced student loan qualifications. I'm doing a lot more training of them, so a large part of what I do is try to teach people like certified financial planners, other lawyers, and university professionals the kinds of things that they need to know to help you and us with student loans. That said, there are hardly any, and it's hard for me to direct you to them. There are a lot of unscrupulous companies that are charging student loan borrowers money for advice that is worthless, worse than worthless. So you do have to be really careful. You want to vet them like you would vet any other kind of professional. Ask questions to see that they know as much, about student loans as you do after this seminar, and you'll probably find that most of them don't. I do not hire myself out to individual student loan borrowers. I work, for example, for your university or for your professional associations. You could consider approaching your employers or your associations about collaborating, for example, with me to provide that kind of counseling for people. It's important to me with my kind of mission-based stuff that I not be charging student loan borrowers for advice. Like, that's not what I want to do. So, but I do want to help create, qualified people that you can get, or get people access to me for their individual situations, but not directly. So that said, there are a few people that are doing a good job, but they're gonna probably charge you a lot of money. I like and respect a guy named Paul Gerard. It's Garrard. He knows a lot and does a good job for people. I think that ideally it's better to have someone who isn't just a student loan expert. Paul is a student loan expert, but isn't a financial advisor, so he can help you figure out your student loans, but you really should be thinking about your money more holistically, ideally. The other thing is that I do work with financial advisors. So to the extent that you're considering hiring somebody to help you plan things like insurance and retirement and all that other stuff, those professionals can hire me to do your case or someone else's case with them. And that, I think, is also a good model, and you should feel free to put them in touch with me.
Great. Thanks, Heather. And you'll include Paul's name when you send that materials to me as well, because we just had a question to include Paul's.
Yeah, sure. I absolutely will. And I just want to thank you so much, Rebecca, and thank the university, because it's really it's great that you value this kind of programming and your alums so much to make it available to them. And I know that I certainly appreciate it.
Well, wonderful. And we have a lot of thank yous coming in. Incredibly helpful, Heather. Thank you so much. Thank you. So we really appreciate you coming to speak with everyone as well. As I said, your handouts are in the handout section, and we will send out a recording of the webinar. And Heather, remind us again how long the information is good for, because I know you said after a certain amount of time you really don't want them to listen to the webinar anymore because new information is coming out.
Yeah, so my concern is what we've talked about is that the information can change and get stale, and I don't want it to be out there too long where I have to keep track of what all I've said and whether it's still accurate. So it'll be at least a couple of months, several months. I forget what we agreed on, Rebecca.
Okay. Just want to let everyone know that, but we'll send out the materials, Paul's name, what you mentioned, and the recording. But I wanted to say thank you again to you, Heather, and thank you for everyone for joining us.
Thanks so much. Have a good night.
Good night.